All right, welcome to this explainer. Today, we are putting Employers Holdings Inc., a mid-cap workers' compensation insurer, through an absolute valuation gauntlet. We're going to take this company and stress test it using the legendary investment frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham. And then we'll back that up with some hard quantitative models. It's going to be a deep dive, so let's jump right in.
Here is our roadmap for today. We'll start with a quick snapshot of EIG, then evaluate it through the Warren Buffett, Peter Lynch, and Benjamin Graham lenses. After that, we'll run some alternative valuations, and finally, synthesize everything into a final verdict.
Starting off with Section 1, the EIG Company Snapshot. So let's unpack the mystery that is EIG right now, because this property and casualty insurer is throwing off some incredibly mixed signals. The recent Q2 2026 earnings report shows a business squarely at a crossroads. On one hand, gross premiums written actually fell 19.6%, down to $163.4 million, and their total policies in force are dropping. But then, on the exact same report, diluted earnings per share jumped 29% to $1.59. Basically, management is deliberately pricing themselves out of certain policies so they can prioritize profitability over sheer volume. When you look at the core numbers, the dichotomy is super striking. EIG looks like a literal financial fortress. They've got a practically non-existent debt-to-equity ratio of just 0.14 and a really solid book value of $47.83 per share. But you simply can't ignore that trailing PE ratio of 74.62. That number immediately demands a closer look because it suggests the market is pricing in a massive amount of expectation, even though the top-line revenue is actively shrinking.
Let's move to Section 2 and run those numbers through the Warren Buffett lens. Buffett famously hunts for companies with wide economic moats and high returns on equity. So as we mentally tick off his criteria, EIG shows some serious strengths, but also some glaring weaknesses. It absolutely shines with its pristine balance sheet, carrying just $125 million in long-term debt against over $858 million in equity. Plus, management is super disciplined, buying back over 650,000 shares in a single quarter. However, it completely strikes out on ROE, sitting at a pretty dismal 1.1% trailing adjusted. And its economic moat? Basically non-existent. They hold just a 0.52% market share in a fiercely competitive workers' comp space dominated by giants like Berkshire Hathaway and Travelers.
Now, to really understand why Buffett might pass on EIG's owner earnings, we need to translate a bit of insurance jargon. EIG's combined ratio is 105.8%. In plain English, that means they are underwriting at a loss. They're actually paying out more in claims and operating expenses than they take in from premiums. The only reason they stay in the green is by relying on $27.4 million of investment income from their bond portfolio. For Buffett, who loves underwriting profit that generates free float to invest elsewhere, that combined ratio is a major red flag.
All right, Section 3. Let's switch gears and look through the Peter Lynch lens. Lynch focused heavily on how to categorize a company, and he absolutely loved finding hidden gems that Wall Street was ignoring. Well, he would immediately flag EIG's massive 80.49% institutional ownership as a huge negative. When Wall Street heavyweights like BlackRock and Vanguard already own the lion's share of your $939 million market cap, that whole hidden gem advantage is completely gone. What's more, Lynch would likely categorize EIG as a stalwart or maybe even a turnaround given that shrinking premium base. Because top-line growth is negative right now, calculating a meaningful PEG ratios using that high 74 PE is basically impossible. It totally fails his growth tests. But there is a fascinating plot twist here. Lynch would be incredibly intrigued by a recent surge in insider and smart money buying. Funds like Clearstead and Bessemer have aggressively bumped up their stakes by over 140% and 220% respectively. Even so, the lack of growth combined with that heavy institutional ownership makes EIG a likely avoid in Lynch's traditional playbook. Moving right along to Section 4, let's see how EIG fares under the Benjamin Graham lens. Graham's entire approach is anchored in deep value, asset protection, and demanding a strict margin of safety. Defensively speaking, EIG performs incredibly well here. It easily passes the adequate size test with a market cap pushing $1 billion. It has a massive, secure asset base of over $3.3 billion, a rock-solid 0.34 quarterly dividend, and a very moderate price-to-book ratio around 1.07. Literally, the only place it feels the defensive checklist is the PE requirement. Graham wanted a PE under 15, and EIG's trailing PE is way above that thanks to their recent earnings volatility. But Graham also gave us a specific formula for intrinsic value. You take the square root of 22.5, multiply it by earnings per share, and then multiply that by the book value per share. If we plug in the forward analyst estimate of $2.15 for EPS and EIG's $47.83 book value, we get a fair value of precisely $48.10. That means at the current market price of $51.48, Graham's required margin of safety just isn't there. He wouldn't touch this stock until the price dropped well below that $48 mark. Section 5. Time to break out the DCF and alternative valuations. So, our qualitative guru models are clearly split, which means we need to bring some raw math to the narrative. Thinking out loud here, building a discounted cash flow model for EIG is actually kind of tricky. Their net cash from operating activities was negative $8.1 million in the first half of 2026. Since that's an anomaly driven by their current policy restructuring, we can't project off a negative base. Instead, we have to assume a normalization of historical industry margins over our forecast period. If we assume a conservative 8% weighted average cost of capital, which makes sense given their heavy reliance on investment yields rather than actual underwriting profit, and we use a 2% terminal growth rate, our base case DCF centers the fair value tightly around $48.80 per share. When you look across the sensitivity range, you'd have to use some highly optimistic assumptions to justify paying much more than the low 50s. And this is exactly why running alternative models is so absolutely crucial. Because of that weird negative free cash flow anomaly we just talked about, relying on the dividend discount model is actually a much safer bet for a company in this position. If we project out their very stable 1.36 annualized dividend alongside that massive $125 million share repurchase authorization, it implies a fair value hovering right around $50 per share. Basically, management's aggressive capital returns are creating a very strong floor for this stock. Which brings us to our final section, synthesis and the final verdict. Let's put all the pieces of this puzzle together. Across almost every strict quantitative model we've run today, from Graham's deep value formula to the DCF, right over to the dividend discount model, EIG's intrinsic value sits in a really tight cluster between $48 and $50. Therefore, at today's price of $51.48, it is currently trading just slightly above its intrinsic value across the board. EIG is just a fascinating case study in fundamental tension. It's like a giant tug of war. On one side, you have incredible strengths, a massive equity base, an impressive A-plus rated credit portfolio yielding 4.9%, and super aggressive capital returns to shareholders. But pulling hard in the other direction are the risks. Active underwriting losses, a combined ratio over 100%, and a steadily shrinking market share in a highly competitive space. Ultimately, when we blend the insights from Buffett, Lynch, Graham, and our math models, our final recommendation is a hold at the current price of $51.48. The stock is undeniably a financial fortress, but the necessary premium growth just isn't there to justify paying a premium above its intrinsic value right now. That said, if we see a market dip that pushes the price down into the $45 range, that would absolutely trigger the buy algorithms for both Graham's margin of safety and our DCF purists. Which leaves us with this final thought to consider. In an industry where sheer scale so often dictates your survival, can EIG's strategy of shrinking its way to profitability actually create long-term shareholder value? Or are they just managing a highly profitable decline? It's definitely something you want to watch closely if you're holding this stock. Thanks for joining me on this explainer, and as always, keep questioning the numbers.